Hi, I'm James and welcome to the channel. I've been a fund trader for about 20 years, and today I want to talk to you about why I think that the world and the US economy is in a bit of a crisis. I'm going to look at things like personal savings, how much money people have got left in the bank. I'm going to look at housing, what's happening to housing prices, and what's happening to construction and all that sort of thing. Bearing in mind that housing and construction and all the associated industries around that sector make up about 12 to 15% of the entire economy of the United States. I'm going to look at credit and debt. How much money do people owe? How much have they got left able to spend? And how much do they owe on those credit cards and home loans and car finance and that sort of thing, and how that affects spending going forward? We're going to look at interest rates. What's the Fed likely to do? And what we can expect in 2023 and how that will affect the economy. And then we'll look at inflation, where it is now and where it's expected to go. And the reason I'm looking at all of these things is because if you're on this channel, you're probably a trader like I am, and you're interested in how these factors will affect the stock market, the currency markets, bond markets, metals, all of that sort of thing. We'll talk about that very briefly at the end. So let's go through them one by one. Okay, so here we've got a great website. It's called tradingeconomics.com. You should have it on your desktop. It's really good. There's all sorts of information on every part of the economy that you could hope for. You just have to click on these selections down the right-hand side, and up in the middle here will appear the data that you're looking for. What I've got here is personal savings. You can see this is a 10-year chart going back to 10 years ago, 2012. Up into start of 2023, personal savings have basically dropped to the lowest by a long way that they've been in 10 years. We had a big spike here during the COVID crisis when people weren't spending a lot of money, weren't going out, weren't going to the shops. People were saving a lot of money, and you can see it had steadily been building up until then. We had a spike then. Since interest rates have started to go up and the economy has started to move down, we've seen personal savings drop down and dwindle down to almost nothing. That means two things. First of all, people will not be spending cash as much as they were because there isn't any left. And secondly, people will be spending more on their credit cards, and we've seen credit card debt go up. We'll have a look at that shortly. To the point where credit cards are starting to get maxed out, interest rates are high, people can't pay back their credit card debts and their personal loans and their car loans and their housing loans, and we're getting into a credit squeeze where people will simply stop spending. That's going to be really bad for stocks and probably good for the dollar because stocks will be going down, metals with no yield will be going down, and we'll probably see some more US dollar strength. But we'll get to that in a minute. But we're talking about the economy, personal savings way down to the lowest level in at least 10 years. And if we can go back even further, I'm not sure if we can. Yes, we can. If we look at this as going back into the 60s now, if you have a look at going back, it's absolutely dire. We're below anything that appears on this chart up until now. This is absolutely critical and crucial. It's going to be very, very serious for the economy. And I'm not an economist, but I think it doesn't take a genius to figure this out. We've got some problems. So let's look at the housing sector. This is the United States existing home sales, and going back to 2022 and beginning of 2022, it's now 23, so about a year. You can see how existing home sales have dropped off incredibly dramatically. And that's really bad news. That the housing sector employs about and is accountable for a huge amount of the American economy, around about 12%. You think of all the construction side of things, you think about estate agents, you think about banks, the transfer, lending, people employed in fixing up houses, people doing gardens, people, all sorts, swimming pools, you name it. It's about 12 to 15% of the US economy and workforce involved in the housing sector. And when you see home sales dropping off like they are here, that's really bad news. And we can look at housing starts. These are new houses, starting out with brand new houses, dropping off dramatically. And you can look at new home sales. There's another number down here, and look at the new home sales. that's not actually too bad. It has ticked up a little bit. There was a surprising number in November, or it was November. So that's new home sales, and new home sales month on month. Well, this whole year it's been pretty bad. But overall, really, really low in terms of housing sales, new home sales, existing home sales, really bad. That's not good for the economy at all, considering that the housing sector employs so many people and it covers so many different facets of the American economy. So we'll see the same trend in construction spending in the US. You can see over the past year, started a pretty strong 2.7, 1.5, and then we started getting a couple of negative months, and then barely in November, just barely positive. To be fair, this is a cyclical market, and if we go back and have a look at a longer term period, it kind of moves up and down between an increase of around 2% down to negative 2%. Right now we're at zero, so kind of in the middle of the cycle of ups and downs between +2 or 3 and -2 or 3. But the trend is down, and we're heading probably down to the negative side of this. So, and again, when you talk about construction, there's a huge number of a huge part of the economy involved in building construction and architecture and building materials, and in people employed in the sector. So we're heading down from a pretty good period in the beginning of 2022, around about that period, moving down to about zero now, and on a downtrend, and possibly heading down to -2 or -3%. So we're going to see a drop. It is cyclical, but if you have a look at the short-term period, it's definitely on its way down. So let's look at private sector credit, United States loans and leases in bank credit. And since the beginning of 2022, look how that's increased dramatically. Quite astounding, really. And then we can also look, whilst we're here, at credit card debt has gone through the roof as well. So there we go, back to, well, this goes back to 2020. And you can see since beginning of 21, actually, up until mid-22, heading towards the end of 2022, credit card spending or credit card usage has gone up. So what we're seeing really is more debt, less cash on hand, less savings, and what that means is that people are spending less cash, they'll be borrowing more, and eventually those credit cards will be maxed out. People are still spending because spending habits die hard, as you will know yourself, as I know myself. Even if one has no money, one tends to continue to spend it with credit cards. And when the credit card, I don't have credit cards, but when the credit card runs out, then there's nothing to spend, and you owe an enormous amount on your credit cards. And with the interest rates high and going higher, we'll have a look at that shortly, it creates a massive problem for the consumer. So all that remains to be discussed is interest rates and CPI. Now, as you'll know, we've had an inflation problem around the world, not just in the US. And as a result and in response, the Federal Reserve in the US has been increasing interest rates throughout the year. We've had an unprecedented rate of interest rate hikes, increases. And the reason is because of the key number that the Federal Reserve looks at is the core CPI, and we've got that in front of us right here, United States core CPI. And this has got to be below 2%. That's their target. Now, it doesn't matter whether you look at CPI, you can look at all the numbers here. There's inflation rate, CPI, core CPI. They're all measured on different ways. You get food inflation, housing utilities, housing rentals, whatever it might be. But the main number is the core PPI and CPI numbers, the main numbers that the Fed looks at. And they want this below 2%. At the moment, it's 6%. And some people think there's a downward trend. Actually, there isn't. We got as high as 6.7. It's just after mid-year in 2022. And we've come down 2 months in a row since then. But just look back to the left. We're pretty much at the levels that we were throughout most of 2022. We've peaked up a little bit, come back down a bit. Now, normally this sort of peak and descent thereafter indicates that maybe we had peak inflation right then, but we still haven't really entered a downtrend. 2 months in a row doesn't make a downtrend, and we're still way above 2%. So The Fed has been very clear in all of its meetings and its minutes that it will continue to raise interest rates for as long as necessary to bring CPI or inflation down to 2%. And they have been resilient and determined and terse and resolute in what they've said about it. So let's have a look at where we are now. Here's the Fed fund rates. You can see where we are. We're at 4.5%. The last meeting was on the 14th of December last year. The next one is coming in next month or the month after. I'm not sure exactly when. It's a little bit of time in between December and this coming one. And you can see the rates of interest rate increases have been quite dramatic. We've had, I think, 3.75s in a row. And we had a 0.5 on the last one. Now, these are going to continue. If you look at the bond markets, they anticipate that. If you have a look at what the Fed's saying, they anticipate that. And this is going to put downward pressure on the stock markets. This is going to keep on rising until this begins to fall. It's as simple as that, really. And we haven't seen this slowing down. That rate of increase has been, well, it was a little bit slower in the last one in December, but still it's quite severe. And this hasn't really changed around. As I said, 2 months doesn't make a trend. So we're going to see continued interest rate hikes. We're certainly not going to see a decrease in interest rates. They've been very clear about it, and traders haven't wanted to hear this. If you look at the charts now, you can see the markets are struggling today. As I'm talking, we're trying to get up every day. There's a little bit of a rally, it falls back down. A little bit of a rally, falls back down. We know that there are going to be continued interest rate hikes. We're going to see continued depression of the economy, looking at the numbers that I've just seen, that I've just showed you, show you where we are at the moment, and it's probably going to get worse. So we're probably going to see the stock markets decrease into the coming year. So 2023 is probably going to be a bearish year. We might see some counter-trend bear market rallies. But overall, I think it means that we're going to see weakness in the financial markets, in stock markets. We're going to see strength in bonds. We're going to see strength in the US dollar as a result of the interest rate hikes. And so we're looking to sell other currencies and buy dollars for now. And possibly we'll see some strength in metals like gold and silver. And that's what lies ahead for 2023. So buckle up and make sure that you've got a little bit of money stashed away somewhere. Don't overspend. And if you're a trader, which you probably are if you're on the side, as I've said, be nimble, be quick. Look across a variety of different instruments. Don't get stuck in one direction against or for the US dollar if you're trading currencies. Look at dollar CAD, look at yen pairs, look at Australian dollar, look at some of the minor and perhaps even the exotic currencies, which I trade myself as well sometimes, things like South African Rand and some of the other very minor currencies. But don't get stuck in one direction against the dollar. If you are going to do that, it's probably going to be long dollar. But even so, it's not a good idea. Be nimble, be flexible, and cover your risk by trading a variety of currencies. If you're in the stock markets, I would be looking to sell rallies, bearing in mind that bear market rallies can be fast and dramatic and severe. And so don't expect the market to carry on down in one direction, because it's not going to do that, because there will be buyers all the way down looking for bargains as the stock market drops, and we'll get these sudden surges in rallies. It could be 10%, 15%, even 20%, some of these big bear market rallies, but those are excellent opportunities to sell. Well, good luck. I hope you've found some decent information. Someone was asking me the other day, what about bank stocks? I think banks are going to struggle, despite what you might read in some of the financial press. People are going to have problems with paying their debts. People are going to have problems with taking out extra debt. Credit cards are going to be maxed out. Housing sales are going to drop. Home loans are going to be decreased. We could enter a housing crunch. Dare I say, similar to what we've seen in the past. I hope not. But things don't look good for housing, for debt, for markets, for businesses, and for stocks. So take care out there. It's going to be a rough one. But for good traders and for those prepared to trade in both directions and to swing the market, bearish or bullish, there are plenty of opportunities. I'll speak to you soon.